Good afternoon and welcome to TradeStation as we discuss today agricultural markets trading opportunities with Dan Gramza of Gramza Capital Management. Dan is a trader, a consultant to domestic and international clients, an advisor to hedge funds, and a developer of ETF securities. He develops and presents worldwide public and private courses on essential mental techniques for traders, Japanese candle analysis, the market profile, technical analysis, options and options trading strategies, stock and futures industry fundamentals and operations. He is a renaissance man in our industry. One of the testimonials on the front page of Dan's website is that Dan Gramza is one of the most honest and sincere market technicians in the commodity industry. Now, I don't know who wrote that, but I would second that, and I'm very happy to have him with us today. Remember that our presentation is for educational purposes only, and all the symbols and trading ideas that we discuss here are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business, including, but not limited to, Hong Kong and Japan. Active trading is not suitable for everyone, and options trading carries a high degree of risk and may not be suitable for all traders. We've placed in the chat panel a couple of pieces of disclosure information regarding the characteristics and risks of standardized options and other asset classes that are available to you as a customer here at TradeStation. I urge you to take a look at those documents at your leisure. Now, our question that usually comes up at this point in the presentation is, are we recording? And the answer is absolutely. We record all of our presentations here at TradeStation, and this presentation should be available tomorrow on the TradeStation University page on the TradeStation website. Also, if you're a TradeStation customer, you'll be able to find it in Video Station on the trading platform, or finally in the TradeStation YouTube page at TradeStation, the TradeStation site in the YouTube channel. So, Dan has his own disclaimer. I'll introduce him right now because he's got a lot to tell us, and I want to get out of the way really quickly. So, Dan, thank you very much for spending time with us today.
Don, it's always great to be with you. Hello, everyone. As Don mentioned, the disclaimer, I'm not a part or affiliated with TradeStation or the CME Group. They're not endorsing anything I'm going to share with you. These are ideas that I hope you find helpful. Hello, Jerome. I just see you signed in. I'm glad you're here. I do produce a daily commentary, as Don mentioned, and here's the site for it. TradeStation has a tremendous amount of information, as you know, because you're here. And please take advantage of it. And they have a daily sources of information that you can look at. One of them is a video that I do every day on 22 different markets to give you an idea of how someone's looking at these futures markets. If you've never traded them and you're curious about them, one place to begin is just watch them. And this way you can watch and hear how someone's analyzing those markets. And you'll see red and green lines, which represent bullish and bearish levels for me. I'm not making trade recommendations, but I do want to show you how someone would attempt to identify a trade and also manage that kind of a position. So you'll see these red and green lines changing as the markets unfold. And you can go back, I think, 7 years in those videos to see what did I say 3 weeks ago or when something happened, give you an idea how someone's trying to react to that market. So that's the purpose behind that. If you have a chance, take a look at that. And again, a lot of other things that are there available for you as well. My background, Pete did a good job. Pete, we were talking about Pete, Don. Don did a great job giving you that overview of my background. I come at things from a floor point of view when I think about the markets, and we'll see that a little bit later on. And and I have a chance to circle the globe a couple times a year working with traders around the globe, which is a wonderful thing to do because the things that you and I deal with as a trader are the things that they're dealing with as a trader. So no matter what country you go to, as a human being, we're all faced with those same challenges when it comes to trading. There are differences, though, I do see institutionally in different parts of the world, but a lot of the fundamental issues that we all deal with are consistent, that's for sure. Now, let's talk about today's agenda. We're going to be looking at the market. I wanted us to understand if someone hasn't be looked at the corn market or wheat market. And so what are these things and where do they come from? Where do we see them growing, not only globally, but also locally in the United States in that regard? So it's going to be an overview of the market. We're going to talk about market influencing factors. We're doing this webinar at a very interesting time of year. We'll talk more about that later on. And then we're going to look at live markets. We're going to look at the relationship between these various sectors that we think about when it comes to the marketplace in general. Then obviously, if you have any questions or anything I can help you with, please type those in. Happy to explore that with you. Well, let's start out with production. First, corn is our biggest U.S. crop. It varies from 65 to about $80 billion a year, to give you a general feel for that. Second place is soybeans, and wheat is in the fourth place in terms of production. Oh, hey, what market do you think would be number 3? What market do you think that we grow would typically be in at the third position of dollar value of a U.S. crop? Any ideas? Type it in there. Peanuts. Ooh, Nicholas, that's a good one. Peanuts, yeah. It's not that though, but that's a good one. Oats. Craig, that's another one. We use a lot of oats in this country. Cattle. Nope, Daryl's not that one. Cotton. Ooh, that's another good one, but it's a fairly regional product. Barley, Jerome, that's another product that we're growing, it seems, more and more of when it comes to that. Those are all really good guesses, actually. Um, it's hay, Hay, because we need that for feed. So hay is our second or third largest crop typically in the United States. But those are all logical things that you picked up there. Well, let's look at the world. If you look at corn is what we're looking at here, and that's basically where corn is grown. Sorry, let me go back to that. Corn is grown around the world. And what you'll see here when we look at that is that here's the United States. So we know in the Midwest and a little bit on the East Coast, we have corn. You can see Europe, it's grown throughout Europe as well as in China. And you don't see as much in India. Also some down in South America. When you look at a chart like this, typically what you'll see when you have things that grow, whether it's corn or wheat or coffee or cocoa, uh, when you see a global map, look at the equator, and what you'll typically see a certain distance above and about the same distance below is where we see that product being grown. So for example, if you and I were going to talk about coffee, it would be grown in a fairly narrow band around the world near the equator. Or if we talk about cocoa, like here in Ghana and the Ivory Coast, we'd see cocoa in Brazil. So it's a fairly narrow band that product is grown. Corn, on the other hand, needs a little bit I guess, cooler temperatures than what we have at the equator, and we see that production north. But let's take a closer look at the United States. Now, this is an old chart. It's from, the Department of Agriculture, uh, but it represents really something that doesn't change very often. And what we're seeing in the dark green areas are where we grow a lot of corn. So the Midwest part of the United States, Indiana and Illinois, Wisconsin and Iowa, Nebraska, we grow quite a bit of corn. But also you see some of it on the East Coast, a little bit. You don't see much grown out west, a little bit in Washington, right? Some in California. But if you look at a big part of our country, the other third or two-thirds of it, we don't really grow much corn. You don't see it up in Maine, for example. And I'll tell you later on why I'm mentioning that. Okay, so that's kind of where it's grown. And this gives you an idea of how we use it. Basically, a couple things to think about 20% to 30% of our corn is used for ethanol. And from that production of ethanol, we get these DDGSs, or distillers dried grain solubles with solubles. That's what that's a production from, an offshoot from. And then we also have some exports, about 11%. A lot of that goes towards China. We'll talk more about them. But if you look at the lower part, where it says dairy, beef, cattle, hogs, poultry, that's another a third or so of our product, corn product, is used for animal feed. And most of the corn that we grow in the United States would come into that category. We're using it for ethanol, we're using it for animal feed. That's over 2/3 of our grain consumption when it comes to corn. Now, production-wise, by country, United States, as you can see here, kind of leads the way in terms of production. China's right behind us, but China does import corn. Again, going back to demand, we'll talk more about that later on. The EU, we got 27 countries, they're number 3. Brazil, Ukraine, Argentina, India, Mexico, South Africa, Canada, top 10. So production-wise, that's where we see the concentration of production. Let's talk about imports. And this one usually surprises people. The number one importer of corn is our friends in Japan. And Mexico is number 2. And you think, geez, they eat so much corn, you'd think that they would be number 1. So they import a lot of US corn, actually. Korea, number 3. Egypt, number 4. EU, Taiwan, and so on as we go down the list. So that's where it's going to when we think about corn. If we take a look at wheat production uh, globally, again, it's about the same areas that we see before for corn. You don't see as much below the south of the equator. Down in Argentina, for example, about the same distance below the equator as we are above. We see wheat production, also in Brazil, southern Brazil, again throughout Europe. Here we see India. India is a large producer of wheat, and China. China is huge when it comes to producing wheat. So let's take a closer look then at the United States. And here's something that's different than what you and I saw with corn. Look at, well, we see some heavy growing areas, right? And up here in Montana and then Idaho and Washington and Oregon. But look at that light pink area. It goes all over almost our country. And wheat is a grass. So it's much easier to grow wheat than it would be corn or soybeans possibly. So we see a lot of production when it comes across the country for wheat. And wheat production by country, the EU's number 1, China's number 2. You know what's interesting about China with wheat is that China only recently meaning in the last, I think maybe 5 or 6 years, started to import wheat. Traditionally, China produced enough wheat for its own internal consumption. It wasn't a big exporter, but it could take care of its own. That has changed. And we'll talk more about why that's changed later on. But as I mentioned to you, India, look at number 3 when it comes to production. Russia, big producer of wheat. So is, the Ukraine. It's number 10, but that's also a major area that people look at. United States, Australia, Canada, Pakistan, Kazakhstan. I mentioned these countries and I wanted to go through those because when we look at this marketplace for wheat or corn and soon soybeans, when we look at that, it gives us an idea about weather. If we have droughts in the Ukraine, for example, I remember a few years ago, well, it was 1997 when I think about it, a few years ago, but and we also had it in 2007 when Russia had a drought, Ukraine had a drought, Canada had a drought, Australia had a drought. You know, we didn't have enough. And when you see something like that, that means the trend that you and I would see for wheat is going to be a strong trend. That's a trend that's occurring because the supply and demand doesn't match up. That's different than an agricultural market moving on an assumption and anticipation of a future event. Total different, even though they both can be movement in terms of trends and big moves, but two different trading opportunities. If you have a market that's anticipating a future event, that one can change direction very quickly. An example, we haven't talked about soybeans yet, but soybeans in part of the country where I live, which is Chicago in the Midwest, we need moisture for soybeans in the first couple weeks of August. Now, it's if we had, if the National Weather Service said the first 3 weeks of August will be drought conditions in the Midwest, soybean prices will probably pop up because we need a certain amount of subsoil moisture to get the flowers on the plants, which determine the pod size and the number of beans, the size of beans. So it's really important. But if we have drought conditions, or in the middle of July, they're anticipating drought conditions and soybean prices move up. Are soybean prices higher because we don't have enough soybeans? No, we haven't even harvested the doggone stuff yet. But soybeans prices are higher because they're anticipating drought conditions, a small yield, and therefore we're not going to have enough to meet global demand. In that trend, I want a fairly tight stop because that can change in a heartbeat. And what we both know is that market will probably come down faster than it did going up. So that's what I mean by anticipation. So when we look at these countries, that weather we want to be sensitive to, but is it something that's going to happen or is it something that's happening? Imports of wheat, and I should have asked you this before I changed to it, doggone it, because Egypt is the number one consumer when it comes to imports, I should say. Uh, Imports of wheat is Egypt, and bread there is important. I think it surprises people to see them here, just like Japan, when it comes to importing product. All right, well, let's move on. And what we're looking at are soybean growing areas, and you have the United States. You got some in the Europe, India, again China, down in South America, and Brazil. And what this tells us, that region of that continent, is that that's the main growing regions. When China goes to buy soybeans, China does not produce enough soybeans for domestic consumption. They go out and buy it. What they do is they go shopping, just like you and I do when it comes to going to the store. They do the same thing, only it's countries, to buy their goods, not the shopping, not a market. But they look at the United States for soybeans, and then they look at our friends down in South America for soybeans. They look at the cost to buy those soybeans. They look at the dollar strength or weakness, which determines the value of our products, as well as the currencies in those countries. So let's look at soybean production. Again, we see primarily a Midwest to Eastern product. You don't see much of that grown in the western part of the United States, so we know weather conditions here are important. And in fact, let's do this. We're at a critical time now because product is being planted. And corn, we're a little behind. I think about this time of year, the 5-year average is around 18%, and I think we're at 5%. Wheat, we're right on target in terms of planting. That's in good shape. Uh, and did I say corn? Corn and soybeans were a little behind. And the challenges are this time of year, depending on the part of the region we're talking about. Imagine that we have a heavy snow and it hasn't melted yet. Or if it's melted, the ground itself is too wet and they can't put the heavy equipment out there to start planting. So both those conditions can keep a farmer from planting when they normally want to. By the middle of May, there's certain products that you want to have in the ground by then. Because the other issue, the challenge that we have, is that we have a growing window for that product. And there's a sweet spot in there. And if you wait too long, you're not going to be able to plant that product. Now we know if we wait too long, corn up in this area, for example, they're going to switch, and that's maybe happening this year. Some farmers may switch from corn to soybeans, or they could switch to wheat. As you go down the country, from the middle part of the country, as you go from the north to the south, we have different choices. As you get further south, and we'll take a look at it, we could start planting cotton. That's another choice. So we got corn. Can we have enough time for the growing cycle? Soybeans, that'd usually be next. And there are some hybrids for corn that can shorten that cycle a little bit. Wheat would be another choice possibly, and then cotton in some parts of the country. So this time of year is critical in terms of what a farmer has to do. You want the temperature of the soil and corn to be at a certain temperature to get the right kind of germination, ideally. To be a farmer is such a tough, tough job. I have so much respect for anyone who does that because you have to know everything. Not only what you and I are talking about, but the myriad of government regulations and what you need to do things properly. It's a tough business. But my point behind showing you these maps and talking about the weather are these conditions that do have an impact on what's grown and when it's grown. So my intentions, if I say to the USDA, my intention is to plant X number of 100 acres of corn. But the reality is I can't get 100 acres in. So maybe I get 50 acres in and I put beans in the other 50. So the numbers that we see, the planting intentions and what gets actually planted, can be different. Now, when it comes to soybeans, United States, #1 producer. Brazil and Argentina, like I said, our friends south, they're right up there when it comes to production. China produces a hell of a lot of soybeans. It's just they need more than they produce. India, people don't think of India as soybean country, but they produce a lot as well. Imports, China, as you can see, is dominant when it comes to importing soybeans. And they need it for oil, soybean oil, and they also need it for animal feed. And again, we'll talk about why that is. There's been such a shift in the agricultural demand in China over the last few years. It's fascinating. We'll take a look at that. Rice, I mentioned that's another one we could look at. I forgot to mention that when we talked about choices. Cotton's one, but rice is another. And you can see in Arkansas, Louisiana, Texas, a little bit out in California, a little bit up here in Washington, are primary rice growing areas. But that could be another crop that we could look at as an alternative. And you can see it's grown in some other areas, but not as heavily. So I wanted you to see that just so you know where it kind of fits in to the production cycle. Now, this is China we're looking at in terms of their demand when it comes to commodities. And, the top we have metals. aluminum, nickel, copper, zinc, tin. Look at those, all in the 40s. So they have high demand. And let's go back to the agricultural aspect of it. No, we'll wait. We'll wait because there's some things I want to tell you about that too. Anyways, soybean meal, 45% of global demand. Holy Toledo. You know, golds, corn, 31%, wheat, 30%, oil, 30%, right? And then we have sorghum, sugar, you know, palm oil, natural gas, barley, a little bit less. But you can see they have tremendous demands internally for the products that we're talking about. So some of the influencing factors are one, a global increase in the North American style of meat-based diet. And whether that's good or not, who knows, but that's what we do see. This increases livestock, chicken, and pork demand and production. In China, 1.34 billion people. The economy increased 500% in the last decade. Okay, so let's stop right there. So if you and I think about it, what does that mean to us? Well, it means that people who didn't have money before have money now. It means in China, more people live in the cities than in the country. So we've seen a shift from the farm to the city. And this is recent. This isn't 20 years ago. It's recent within the last few years. You know, over 350 million people have moved from farms to the city. That's the United States moving to Mexico or to Canada. So it's a huge change. And with that change has come an increase in income. And with the increase in income, there's two things I think that you and I can use as a barometer of a country's growth. If you look at the consumption of protein, and that's kind of what you and I are going to do today with China. As the wealth has increased, so has their consumption of protein. I think the next area that I find maybe not as strong an indicator, but interesting, is the consumption of gold. And we're going to talk about metals in the future. But the consumption of gold, we also see changing. Example is China. China is the #1 consumer of gold. They surpassed India. And India would traditionally, for many, many years, consumed twice the amount of gold that the United States consumes. So we've seen their economy increase. And with that, we're going to see the consumption of protein. Since 2000, dairy herd increased 300%, pork consumption increases 26%. China's the largest consumer of pork in the world. And you know, this whole thing about the tariffs, what I do find kind of interesting is in the United States, um, is it Smithfield? Yeah, I think it's Smithfield, is the largest producer of pork in the world, an exporter. China, it talked about, I don't think they've done it, but adding a 25% tariff on imported pork. China owns Smithfields. So it's kind of an interesting situation if that actually happens. But let's go back to this consumption. Since 1990, chicken demand increased 400%, corn production increased 38%, but corn demand increased 50%. Hence, they're buying US and South American corn. The biggest hog producer and consumer, China. Annual meat consumption, 16 kilograms per person 25 years ago. 53 kilograms per person today. So market influencing factors, it takes to give you a feel for when you think about protein. It takes 3 to 7 pounds of grain protein for 1 pound of meat protein. 1 bushel of corn converts to about 8 pounds of beef or 15.6 pounds of pork or 21.6 pounds of chicken. Just to give you an idea of how this comes together. Every 6 years, the equivalent of a North American population is added to the world. China is urbanizing at a staggering rate, as I mentioned. In 35 years, China has added more than 500 million people to its cities. It has over 15 cities that are more than 10 million people. China's megacities, those with more than 10 million people, have, I don't think exploded is the right term, but they're there's so many. More than how many cities in the United States can you think of with over 10 million people? Less than the number of fingers you have on your hand. U.S. industry uses 700% more corn than we did 10 years ago. U.S. government mandate renewable fuel increases from 9 billion gallons in 2008 to 15 billion gallons in 2015. Tyson Foods. Now, this is an old number, but I wanted you to see this because it just gives us a feel for how does this fit in to our lives. Tyson Foods, the largest U.S. meat processor, said in September 2013 it paid $250 million more for grain and feed in its fiscal third quarter that ended July 2nd, 2011. Cornmeal and soybean meal, approximately 42% of Tyson's cost to raise chickens. And the institutions that I deal with in that sector, in the agricultural sector, whether it's a meat producer or a processor of starch, those super large companies, when you think about what they do globally, hedging, these products that we're talking about are really a standard part of their operation. They can't afford to operate with the risk that they would take on if they wouldn't hedge. Not only meats, they can hedge live cattle and lean hogs, but also these grains that we're talking about today. It's a big portion of their cost. Market influencing factor, higher oil prices. People don't think about crude oil and agricultural products, but they can make it more expensive by increasing the cost of fertilizer, irrigation, transportation of farm supplies and harvest. With the static farmland base that we need to feed an increasing number of people globally, and feed a growing livestock herd, like we've seen change in China. Meet an increasing demand for ethanol if we're going to continue that route. So droughts, when it comes to influencing, as I mentioned, droughts in major wheat producing countries, when we talked about that previously, low grain reserves. What we look at when we talk about these products, we talk about a couple of different things, and we'll again look at it in just a minute, but so you understand where that fits in. When we look at the bigger picture, you look at it and say, well, how much do we have left over from last year? That's the carry out, they refer to it as. So how much do we have left over from last year? And we're going to carry that forward to this year. How much we think that we're going to plant? How much do we think could be the yield? And then finally, when we get the yield, is it enough with last year's carryout to meet global demand? And there's a number of sources of information. Again, for those of you involved with TradeStation, they give you a lot of sources of information that can help you determine these things that we're talking about. Diversion to biofuels. All it would take is a stroke of a pen in Washington, D.C. that could change everything when it comes to biofuels, just like it did when they created the mandate. So the consumption pattern of corn changed at that moment, and it could again if that happens. The US dollar, our strength of our currency has a big impact, because are our goods more expensive or less expensive than our competitors? So a weaker dollar when it comes to corn or agricultural products, that's helpful for somebody else to buy it. acres planted, expected yields, carryout, what we talked about. Those are all the factors that come in to play to figure out, all right, what's the expected demand? Am I going to have enough to meet that demand? And that's what we're trying to figure out. Those are the factors that come into play, and it's going to come into play more at the end of the growing season, in September, October, right in that time period is where we're going to harvest a lot of our product that we planted. And again, what we intend to do, what we actually get done, and the yield we get, there's a lot of variables in there. And the result of that is it can trade or create volatility. Now, as a trader, it's a wonderful thing because volatility provides opportunity from a trading point of view in general. No volatility means that we're going to be looking at selling option premium or something else to take advantage of a sideways move. So the agriculture markets, if you've never looked at them, can be incredibly interesting. Now let's talk about some of the contract specs for corn. By the way, you have options on these products as well too, as you can see here, and they're American style options. In corn, C is the symbol for it. It's traded in cents per bushel, and 1/4 of a cent equals $12.50. That's the value, and that's the minimum amount that corn can move up and down, is 1/4 of a cent. And that actually is derived, I don't know if you really want to know this, but it's derived from the Spanish piece of 8, which is also why we used to trade stocks in eighths, and then we changed it to sixteenths. It all goes back to that period of time, actually, and we still maintain that when it comes to these agricultural products. So it's traded in the minimum amount, 1/4 of a cent. And that means if you move 1 full cent, 1 full penny, that would be $50. And we have options on that too. They're traded in eighths of a cent or 6 1/4 per tick. Soybeans, S is the symbol, and is also traded cents per bushel, 1/4 of a cent, just like corn. So same increment. And for wheat, we also have the same thing. Wheat futures are traded in 1/4 cent, and that shouldn't say soybeans, but that should say wheat up there on the top. And so they all trade in 1/4 cent increments, $12.50, and 1 cent is $50. Now, the next thing I thought we could take a look at is what I call behavioral Japanese candle charts. And I know some of you are familiar, probably many of you are familiar with candle charts. And what I'm going to talk about if our paths haven't crossed before, and Jerome, you've heard this many times, I know. So thank you for your patience. Let me move my question thing, just move down. There we go. All right. Well, let's talk about this. And as you know, many of you know that they draw a box between the open and close for a candle, for a Japanese candle. And if the closing price is above the opening price, this box, or it's called the body of the candle, I think it represents buyers coming into the market. This is a technique that I saw in Tokyo, in Japan, in the mid 80s. And I was there to teach a different strategy actually, and it was with other customers of the Bank of America. And we went into the dealing room to find, these were yield curve traders. So we were looking at interest rate markets, and we looked for trades in the 30-year Treasury bond. And as we were walking out, I see a gentleman at a desk drawing these candle charts that you and I are looking at. And I asked Kuno-san, the gentleman I was with, what are these? And he goes, oh, these are Japanese candle charts. When they were kind enough to talk to me about that, this is what went through my mind, what I'm sharing with you now. Because if you're on the floor of an exchange, one of the things that you could see is the total global order flow that goes to a market during a set period of time. when, because the market didn't always trade almost 24 hours a day. And if you stood outside of the US Treasury bond pit, that 30-year bond, if somebody wanted to trade that market, it had to go to that pit. And what you would see if you're standing outside on the elevated steps, you would see brokers. And what you could see from those brokers is the size that they were showing. You don't know who's doing it or anything like that, but you can see by their hands and what they're saying what size they were trading. And then you can see by their hand also what price they were trading. And so what I noticed was when I could focus on their hands and see what they were doing and then look at a chart, I saw, from my point of view, a direct correlation between the two. So what causes a market that opened at 50 to close at 70? Well, if you were watching their hands, you would see buying order flow coming into the market. Their hands are coming up and they're trying to buy the market. And then sometimes they're selling it, maybe a little profit taking, and we see it going back and forth, back and forth. But by the end of the day, we're trading at 70. Why were we trading at 70? Because more people wanted to buy this than sell it. The other side of that trade oftentimes are market makers. They're in and out in a flash. The footprints I believe that you and I follow is the order flow for a market. And I think that's what we're seeing here. And I think in this case, I would say that order flow is to the buy side. On the other side, when the closing price is below the open, I think that represents sellers coming into the market. Sellers, again, competing against each other, which drive the prices lower. Just like the buyers competing against each other drive the prices higher. And it's what you're looking at is a dual auction. But we're looking at it as an auction though, right? If we all want to buy something at the same time and the price is 50, one of us is going to have to raise our, and we're all trying to buy it at 50. Sooner or later, one of us will say, I'll give you a better price. I'll give you 50 and a half or 50 and a quarter. At that point, that seller may take the other side of our trade. And it's that competition that you and I are looking at here. So when the highs and lows don't match the body of the candle, you see that vertical line on the top, that's called a shadow, or Jerome, it's also called a wick. Jerome gave me that idea. I don't know, where was that, Jerome? I think that was in California where you and I saw each other, or Las Vegas, I can't remember now. But it could be the wick of the candle. And that's an example of why we call it a candle chart, because it looks like a candle. And it's also the way it was described to me as a candle chart. I think that represents sellers. And on the downside, yeah, you're right, Las Vegas. When the low doesn't match the body of the candle, that's the tail of the candle, or we could say that's also a buying shadow. And that tells us something about market acceptance or market rejection. When this green candle, well, actually, let's start down here. When it opened, after it opened, sometime during its life, it traded at that low. And when it did, that was a red candle. So it was trading below its open. And when it moved up, it had found buyers pushing it higher, higher, higher. And when it got beyond the opening, it now turned to a green candle. And when it traded at the high, that green candle extended to the high, didn't it? But at that price level, for whatever reason, it started to back away from that high. And I think of it as the market finding selling, or another way to say it is the market is rejecting those higher prices, just like the market rejected those lower prices. Okay. So let's take a look. Oh, my next webinar is going to be May 8th. And we're going to be talking about the fundamental and technical drivers of crude oil and natural gas. What an amazing marketplace those are. Geez, so many things have changed and so many things continue to change. And the United States role And the global energy market is changing. Our ability now to send LNG to different places. Just a few years ago, we really didn't export much and we didn't have facilities to export. Now we do, and we can export crude oil. It's really changed the dynamic. So it's just a fascinating time. I hope you and I can be together for that one. That'll be fun. Okay, well, let's do this. Let's go over here, and I'm going to see if I can pull that up here. In just a minute, you should see some charts. I didn't hear let's try that. Come on. There we go. I think you have these charts in front of you. Now, what we're looking at are a variety of different markets. And I wanted to look at this with you this way so we can think about how these kind of impact each other. Starting on the top, what we have is the S&P, NASDAQ, Dow, and the Russell 2000. Then we have the euro currency. We have the Swissy, Japanese yen. The middle row, Aussie dollar. We have the British pound, Canadian dollar, our friends in Canada, the 5-year notes, 10-year notes, 30-year bonds, so interest rates, gold, and then the bottom row, we have silver, copper, crude oil, natural gas, and soybeans, corn, and wheat. Now, let's take a look at what's going on up here. One, we see some weakness in the stock market. And, we've had some, Caterpillar came out with some things that even though I think the company's doing well overall, they said that they've reached their high water mark maybe for the year, this first quarter. So they feel that there's some challenges to that company going forward. Steel prices may be one of those challenges. We've seen some other companies come out with earnings that have been okay, not terrific. I'm hoping that it gets stronger as the week goes on because we have a lot more companies reporting. We see in the currencies, just quickly, that the euro, let me show you that a little better. The euro got a little stronger. All right, so here, let me pull that over so you can see it. What it means for us is that the euro strengthened a little bit. You can see it's been getting weaker. By the way, what I mean for that is it's the euro US dollar. So these numbers you see on the right side represent US dollars. And this chart represents the cost of a euro in US dollars. So up here, it would have cost $1.24. Today, it costs over $1.22. So it dropped a couple cents. So the euro got cheaper. The euro weakened, which means the dollar, which is the other side, strengthened. Well, we've seen a change here. Is this profit taking or is this a changing characteristic? In other words, did the dollar get weaker because of what we're seeing in the stock market? Is money flowing away from the stock market to the euro, away from the US dollar? And we can see our British pound firmed up a little bit, Canadian dollar firmed up a bit. Nothing dramatic, but it firmed up a bit. And what does that US dollar have an impact on down here? Let's look at soybeans. This is a market. Let me show you that. It's very interesting. We've seen some volatility in that market. And this is the daily chart we're looking at. And it slowed down a bit. One of the things I talked about yesterday in the video is that we were approaching levels in these agricultural products that we may start seeing evidence that buyers could come back in. Well, today we saw a little bit of that, a market that struggled a little bit. But let's look at the bigger picture when it comes to this business. And let's look at a monthly chart. And if we think about where this has come from, it's such a challenge, again, being a farmer. You think about what they what they go through and the risks that they take, which is why hedging is so important for that business. But here, let's look at just the last few years. This is 2012. You can see we've been kind of flat. We've had some pretty good moves. We had double-digit beans, beans in the teens, which used to be a saying on the floor. Some strength there. But now let's look at the last couple years. Fairly flat, isn't it? Let me pull that over so you can see it a little bit better. Really a tough area there. There we go. See, so we basically have been flat through 2017 to now. And so if you look at the daily chart, what you're seeing is just this market riding back and forth. And usually when you see a market going sideways, that's something that grows like this market. A few things that go through my mind. Is that typical? Is it typically flat this time of year as people are waiting for information? We saw that in 2016 towards the latter part of the year. We saw that previously in 2015 from July on. And this period is when people are waiting for harvest. What are we going to get? And right now we're at the very beginning. But we're seeing that sideways move continuing from last year. In other words, so far this year, we haven't seen the volatility that we've seen in the past because of our planning intentions, what's getting into the ground. We're a little bit below average. We need some things that can, again, sow or create some doubt. And that's what the market's going to be focusing on. It could be weather right now. It could be the inability to get the right amount of crop in the right amount of time. So that's the monthly chart. Let's go back. And where's there it is. Here's the weekly, just to give you a feel for that. And again, you see that representative sideways move. Look at the behavior on the edges. And what I mean by behavior, look at the shadows. What does that tell us when you see this market making new highs, but yet it's being done on selling? Or it makes new lows and it's being done on buying? And what a struggle going higher. And when you see this sideways move like this, with shadows on the top and shadows on the bottom, they tell us that they're selling the rally and buying the break. That's what I talk about in the videos. And so this behavior that we're looking at, not unusual for this market or any other market. Oftentimes in the grains or in the meats as well, this could be hedging. People could be locking in hedges just so they can plan ahead during that period. That could be the action that we're seeing. And last week we saw this market get weaker. Now let's go to the daily again for this. And we can see it's been breaking down for the last few days. There was anticipation of actually crops from coming out of South America that there could be some issues. Their yields were less than expected, and we saw some positive reactions here in beans. We'll see it in corn also. And then the issue right now, are we getting the product in the ground? Things look okay. We're just iffy. It's not terrible by any means. So we saw some weakness. Where is the US dollar? Well, we saw the US dollar has been getting weaker. I mean, the euro's been getting weaker. And today we saw the US dollar was getting weaker with that positive movement there. And we're seeing a balanced market condition. Shadows are about the same on both sides. So the continuation of a sideways move, seasonally, activity-wise, it's somewhat normal. In the next couple months, though, this is where we could see some volatility. Now, let's put this guy back, and let's take a look at corn and see how that's shaping up. And what we can see here with corn, let me show you the monthly too. This is interesting. I mean, look where corn was just in 2009. Now, we had a lot of commodities pump up when we had the break in the market because that's where capital was flowing. It was flowing away from the stock market into commodities because they felt in times of uncertainty, this may be a place where we could see that volatility. And we had that. But look at it over the last, this is 2013. Look where these prices are, back where they were in 2010 for one. And we're not finding any dramatic surge in buying so far for this market. And so that's our monthly chart. Let me just show you the weekly. Weeklies are interesting because they give us an idea of how confident a market is. You know, and right now we can't say much about this week because it's not over yet. And it could be a lot different by the end of the week. There we go. Let's pull there. That's a little better. So it could be dramatically different. What we do know so far this week, we've found a little bit of buying coming in. But the question is that sellers buying to take profits? Or has this really gotten low enough to find buyers like we found them before? I kind of lean towards that way. Now, if that's true, that means by the close of Friday, we should be trading above 392. If that's true. If we're not, then that would imply the continuation of a sideways move. Wow, what an interesting market. Ooh, let's check out wheat. Wheat's in its own little world right now, it seems. Now, let me give you the monthly so you and I can get a feel for where is it. You know, I like looking at monthly charts because it gives me an idea of where is this market. Is it cheap? Is it expensive? Well, compared to where we were in 2012, about July, it's cheaper, right? So we've seen this downtrend for the last few years on the monthly chart. Is that going to continue? So we know wheat right now is relatively cheap compared to where it's been over the last few years, last 6 years or so. Now, let's take a quick look. Whoops, get over here. There we go. At the weekly chart, to give us an idea of how this market's been behaving. And, you know, again, we're approaching levels that we found buyers before. And that's why I mentioned in the video, we may have that possibility. But you know something too? If by the end of this week, we're not trading above that previous high here that we're seeing, a little bit above 460, not a good chance for a continuation up. It would imply, then you'd have shadows on the top and the bottom. It would imply a sideways move, a neutral zone type trade, I call it. So, you know, this week and next week could really determine some long-term activity for these markets. That's a tick chart. Let's go to a daily chart. There we go. And we can see today we had some strength here. And we know that the planning for wheat looks pretty good right now. We know that the dollar is getting a little weaker today. Is this a positive sign? It's the step in the right direction, that's for sure. But I want you to look at this chart and tell me how many times do you see more than one green candle? Just a few times. You know, over here at the beginning of the chart, January, a little bit in February. Here we are in February, latter part of February. A little bit of follow through. In April, we had that. Here we didn't. So can we get follow through? The next 2 to 3 days for this market, very important. So by Friday, we would want to see this market closing above 480 with conviction, you know, and it should be able to, if it doesn't do that, then again, we're looking for a sideways move. I'm not bearish on any of these markets, but I think there's some challenges ahead and it's setting itself up for some high expectation over the next few weeks. So I hope you have a chance, if you've never traded these markets, to take a look at them and just watch them. Again, that's the whole idea behind the videos, is to give you a reference just to see them, or go back for a few weeks if you want to look at those videos that I do and give you an idea of how they've been moving. So, and how I've been taking a look at them if you're interested in that. Well, I hope today gave you some things to think about when it comes to some of the agricultural markets. They're fascinating. They do provide, I think, interesting potential opportunities, and they can be volatile though. So it's something that you and I would definitely have to pay attention to. Like with any market, I would never trade it unless you had your trading strategy figured out and you have your risk management figured out before you ever touch it, like we would do with any market. But if you do, these may be something to check out. Well, thank you very much for today. I appreciate you sharing part of your day with me. I wish you much success. And Don, thank you for your guidance today, and TradeStation and CME Group for making this possible. Looking forward to next month.